Chapter 14 is the how-to chapter for the defensive investor, the person who wants stock exposure but prefers safety, simplicity, and modest effort over trying to chase big winners. Graham boils this down to two practical paths for building a diversified, low-risk common stock holding. 1. Buy a broad slice of the market. His simple example is the 30 Dow Jones stocks, buying a true cross-section. Or 2. Apply a set of conservative screens and pick only companies that meet all of them. He then gives a concrete testable checklist, 7 requirements that, if met, should give the defensive investor a portfolio made up of large, stable, financially strong companies selling at reasonable prices. The 7 are straightforward and meant to cut out both tiny, fragile firms and highly priced glamour stocks whose future performance must be assumed in order to justify the price. The 7 selection rules are: 1. Adequate size, avoid small companies. Graham's round cutoffs were conservative. 2. Solid financial condition, current assets at least twice current liabilities. Long-term debt no greater than working capital. 3. Earnings stability, the company should have earned something in each of the past 10 years. 4. Dividend record, uninterrupted dividends for at least 20 years. 5. Earnings growth, at least a 1/3 rise in per-share earnings over the past 10 years, measured with 3-year averages. 6. Moderate PE. Price should be no more than 15 times average earnings of the last 3 years. 7. Moderate price to book. Price no more than 1.5 times book value, with a blended rule, PE ratio times price-book ratio equal or below 22.5 to allow some flexibility. Graham applies the tests to the Dow at the end of 1970 as an example. The aggregate Dow Jones Industrial Average met them as a group, but when you apply the screens to individual names, only a handful, American Can, AT&T, Anaconda, Swift, Woolworth, passed every test. That's the point. A defensive investor doesn't need dozens of clever picks. He needs a manageable universe of acceptable, boringly reliable companies. Chapter 14 also explores industries where the defensive approach works especially well. Public utilities historically fit Graham's rules. And where it's more dangerous, railroads are a strong cautionary example. Cyclical, heavily regulated, with a history of bankruptcies. The chapter ends with a philosophical point. There are 2 legitimate ways to analyze stocks: the predictive, qualitative approach that tries to forecast future growth, and the protective, quantitative approach that insists on a margin of value today. Graham recommends protection for defensive investors. Buy value you can measure rather than promising futures you must hope for. The modern commentary in the book updates and amplifies Graham's practical advice. Index funds as the simplest defensive solution. Today, the easiest, lowest-cost way to get the Dow Jones Industrial Average style cross-section is a total market index fund. For most people, that's the sensible foundation. Trying to beat the index costs time, fees, and risk. Updated thresholds. Size cutoffs that made sense in 1972 are much higher now. A reasonable modern floor for a defensive stock might be $2 billion market cap, but the spirit is the same. Avoid tiny, fragile companies. The screens still work. Big data checks, current ratio, dividend history, multi-year earnings remain useful filters. And in many bear markets, the best opportunities appear among formerly hot names that now meet conservative financial tests. Don't forget due diligence. Even for defensive stocks, read the annual report, the footnotes, and Form 10-K 10-Q. Check institutional ownership, option overhang, pension assumptions, and unusual accounting. Diversify. The commentary stresses what Graham implied. Hold a broad core. Modern advice often suggests 80 to 100% in a low-cost index fund and only a small portion to tinker with individual stocks. Diversification is insurance against being wrong about any single business. Bottom line, if you're a defensive investor, favor simplicity and margin of safety. Either own a broad, low-cost index fund or construct a portfolio from large, well-financed, dividend-paying companies that pass conservative screens on size, stability, balance sheet strength, earnings growth, and price. Don't pay a high price for hope. Buy value you can measure and let patience do the rest.